Okay, let's dive right into this. Welcome to today's Explainer, where we're going to settle a massive financial debate by running the ultimate 20-year race. We're going to follow two completely different paths to wealth. Let's set the stage. We have two guys, Ryan and Sam. They're both 28 years old. They both make $55,000 a year. They live in the exact same city, pay the exact same rent, and most importantly, they're starting at the exact same starting line with exactly $30,000 saved up. The only difference between them is what they're about to do with that 30 grand.
Right out of the gate, their approaches just couldn't be more different. On one side, we've got Ryan. Ryan takes his $30,000, buys a $1,500 trading course, sets up two glowing monitors in a dark room, and starts hunting for those life-changing trades. He's up at 6 a.m., he's trading before work, during lunch, late into the night. I mean, he is really hustling. On the other side, we have Sam. Sam reads that almost nobody actually beats the market, kind of shrugs, drops his money into a total market index fund, sets up an automatic $200 monthly deposit, and goes to sleep. Basically, he forgets the account even exists. And this highlights a huge psychological trap we all fall into, right? Ryan's path feels like winning. It feels like a skill. Sam's path just feels like giving up. But as we're about to see, our brains are basically wired to confuse being busy with getting ahead.
So to see who actually wins this thing, we're going to track them across this 20-year timeline. We'll check in at years 1, 3, 5, 10, and finally, year 20, to see how the math quietly plays out over a lifetime. Let's start the clock. Year 1. And right out of the gate, Ryan's story looks absolutely incredible. He hits a hot streak. A few tech names run, he catches them, and his $30,000 quickly turns into $40,000. He's screenshotting his green days, he's posting in his Discord server with all the rocket emojis, and he is just feeling on top of the world. He's validating all that hustle. Meanwhile, Sam's account has just slowly, boringly drifted up to about $35,000 through his automated deposits and natural market drift. Honestly, if you froze the tape right here, you'd swear Ryan made the smarter choice. But here's the catch with that. A coin that lands heads 5 times in a row feels an awful lot like skill, even when it absolutely isn't. And that brings us to a really crucial realization. Activity is loud, but progress is silent. Ryan is experiencing the loudest possible validation right now, but he's actually in extreme danger. Why? Well, because the market just taught him the wrong lesson at the absolute worst possible time. It taught him that his frenetic activity equals guaranteed financial progress. Let's jump to year 3 and see how this builds. Because by year 3, the coin starts landing tails. The hot streak violently reverts, the exact way hot streaks always do. Ryan hits a brutal stretch, tries to win back a loss by doubling his position, and ends up watching the floor just completely fall out from under him. It's called revenge trading. After 3 years of treating this like a grueling second job, losing sleep, and constantly battling his own emotions, Ryan's account is sitting right back where it started, at roughly $30,000. All of that intense effort, just a walk in a circle. And the crazy part? Ryan isn't just unlucky. He is completely statistically normal. Get this, there's a massive empirical study out of Brazil that tracked day traders over a 3-year window. Out of the committed ones who actually stuck with it past 300 days, a staggering 97% lost money. They didn't just underperform the market, they actively lost their wealth. So Ryan ending year 3 flat isn't some tragic anomaly. It's practically the statistical median outcome.
If that wasn't a big enough punch to the gut, check out the data from the Taiwan Stock Exchange. Economists pulled 14 years of complete trading records. The result? Fewer than 1% of day traders could reliably earn a profit after costs. Less than 1%. Keep in mind, Ryan is trading against spreads. You know, that tiny gap between the buy and sell price, which he has to pay hundreds of times a year. Plus, he's competing against algorithmic machines that can literally see price movements and act before the light from his monitors even reaches his eyes.
We jump forward on our timeline to year 5, and this is where these two paths completely diverge. The survival rate of day traders is dropping off an absolute cliff here, while the long-term strategy finally starts showing its teeth.
By year 5, Sam's perfectly boring index fund account has curved upward to $63,000. It's no longer just crawling. The gains are starting to generate their own gains. It's the quiet monster of compounding. Meanwhile, the statistics tell us that only about 15% of day traders are even still surviving at this point. The rest have completely blown up their accounts or drifted back to normal jobs. Ryan is now just desperately fighting to stay in that tiny 15% survivor pool.
Now, some people will hear this and say, sure, most beginners lose, but the actually skilled traders win. But here's the reality check on skill. Ryan isn't just competing against other beginners in their bedrooms. He's competing against Wall Street professionals equipped with Bloomberg terminals, massive research teams, and literal economics PhDs. And we know exactly how those pros do thanks to the Spiva scorecard, which is essentially a yearly tracker showing how many elite professionals actually manage to beat a simple index fund.
Over a 20-year period, 92% of them lose. Just let that completely sink in for a second. 92% of the smartest financial minds on Earth, with unlimited resources, failed to beat the very same fund that Sam set up on his phone in 1 minute before he went to sleep. Think about Warren Buffett's famous $1 million bet. He wagered that a plain, simple index fund would beat a hand-picked basket of elite hedge funds over a decade. And he won so decisively that the hedge funds actually conceded the bet early. The simple index fund returned about 7% a year, while the expensive, supposedly brilliant hedge funds returned a measly 2%. So when a day trader thinks they have some unique edge, they really have to remember they are getting crushed by the exact same simple market forces that crushed the billionaires. But let's be incredibly clear here. Sam's path is not magic, and it certainly isn't risk-free. The hardest part of indexing is entirely psychological. In 2008, Sam's fund dropped 37%. Over a third of his wealth just vanished on paper. The same thing happened in a matter of weeks in early 2020. Sam felt that panic. He sat there with his thumb hovering over the sell button, his instincts literally screaming at him to get out. His entire edge, his one heroic act, was simply his ability to do absolutely nothing. Not pressing that button was worth more than every single trade Ryan ever made.
And there is another silent enemy quietly working against Ryan this entire time: taxes. When Ryan actually does make a winning trade and holds it for a few hours, the government hits it with a short-term capital gains tax. That means 22 to 24%, sometimes even more, is skimmed off every winning trade, every single year. Sam, on the other hand, is completely rewarded by the tax code. He qualifies for the long-term capital gains tax, which is often around 15%. And the most important part? He doesn't pay a single cent of it until he sells decades later. Sam's money compounds untouched, while Ryan's pile is constantly shrinking from taxes. But honestly, all of that pales in comparison to this number right here, 10,000. That is the estimated number of hours of his one and only life that Ryan spent staring at 2 glowing monitors over the years. 10,000 hours trying to beat a market that was actively beating him. Sam? Well, Sam spent about 1 hour total setting up an automatic deposit. When you measure wealth by the hour, Sam is quietly the highest paid person in this entire 20-year race.
And that brings us perfectly to our finish line, year 20, the absolute moment of truth, where we definitively settle the score.
Let's look at the final data. Sam put in a total of about $78,000 of his own money over those 20 years. His final value? Somewhere between $250,000 and $340,000. And he never even learned to read a stock chart. $250,000 of that wealth is pure, unadulterated compounding that showed up simply because he left it alone. And Ryan? The overwhelming statistical odds say Ryan quit trading years ago. If Ryan had just put his original $30,000 into that same boring fund on day one, he'd be standing exactly where Sam is now, except he'd have 10,000 hours of his life back. So the absolutely crucial point is this. The real trap Ryan fell into was believing that the immense effort you put in should match the money you get out. But in the stock market, that relationship is totally backwards. The market doesn't hand out prizes for trying hard. It hands them out for being patient. Patience looks like laziness right up until the exact moment it looks like absolute genius. Because as we've seen, the market doesn't pay you for effort. The market charges rent on activity.
I want to leave you with this final, perspective-shifting thought. The next time someone shows you a flashy trading screenshot and tells you that boring index funds are just for people who have given up, don't ask them how much money they made. Ask them this: how many hours of your life did that actually cost you? Because the guy who bought the boring fund wasn't being lazy. He was fiercely protecting his most valuable, non-refundable currency, his time. Something to really think about as you plan your own financial future. Thank you so much for joining me for this explainer, and I'll catch you on the next one.